Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 14th of August. I'm Daniel Lam, your host for the podcast. It was a tale of two CPIs last week. While the softer than expected US CPI was seen as comforting by investors, the falling Chinese CPI triggered further concerns about the Chinese growth and, by extension, global growth. So the US CPI rose by less than expected on a headline level to 3.2% year-on-year. Shelter inflation, which accounts for nearly one-third of the CPI basket, remains high at 7.7% year-on-year. But the slowdown in rents and house prices suggests that shelter inflation pressures are likely to ease over the coming months. But on the other hand, China had fallen into deflation. The July consumer prices fell by 30 bips year-on-year. Meanwhile, the 4.4% year-on-year drop in producer prices fell below expectations of a 4% year-on-year fall and marks the 10th consecutive month of decline. But we need to put things into perspective. It is worth noting that there is a vast difference in economic surprise between the two countries. So if you plot the economic surprise indicator of China minus that in the US, the spread between the two is at its lowest since the start of the COVID-19 pandemic. In other words, the bar to beat is low in China right now compared to the US. Yes, besides deflation, there are also issues about Chinese property bonds last week. But the slight surprise from government stimulus may lead to reasonable short covering flow into Chinese equities, which continue to trade at a 35% discount in terms of 12-month forward PE versus global equities. Moreover, lately, there have been signs of fatigue in US equities. So, for example, Nasdaq 100 has been making lower lows and lower highs in the second half of the year so far. Key resistances have been coming off from 15,932 down to 15,803. On the other hand, there has been emerging outperformance from S&P 500 versus Nasdaq 100. So recall the concept of the comfort zone that we've been highlighting a few months ago, i.e. investors sticking to the tried and tested US growth stocks that have worked for them handsomely for more than a decade. Now it is natural to see some mild rotation into other US equities because these try and tested stocks have been running so hard in the first half of the year. And when US economic data slows and fails to beat expectations, investors may begin to rotate some exposure from US equities to the other regions, such as Asia ex-Japan and Chinese equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.